Market seesaws between red and green even as the Adani Group issues linger and uncertainty continues on the interest rate trend. Metals, realty and banks are weak while IT ekes out some gains.
MSCI says it is reviewing the free float of Adani Group stocks and it will make any changes with the periodic review of its indices today. Also, France's Total has put its hydrogen JV with Adani on hold pending an independent audit.
Cummins jumps on a strong all-round performance. Trent gains on strong retail sales, but a sharp contraction in margin hurts Piramal Pharma, while losses at its Indonesia unit tells on Restaurant Brands Asia.
Kotak Mahindra Bank CEO Uday Kotak tells CNBC-TV18 that companies should borrow more from Indian lenders than from overseas and that there's a need for banks to build skills and capacities to meet those needs.
Hello and welcome to Halftime Report. I'm Sonal Bhutra and with me are Ekta Batra and Manglam Malu. Hey guys, good afternoon. It's a very quiet day, right? We have been seesawing between gains and losses. So for now, the Nifty is off around 70 points from the day's low but has actually been in the red for quite some time. So Nifty is down 24 points and Bank Nifty is the one which is underperforming with cuts of around 200 points. Across the board, we are getting earnings reactions and that is something that is determining mood of certain pockets and certain stocks as well. So that continues to be the focus as well, and we have a lot to talk about as well. Mutual fund data, for instance, and a lot more stories as well.
Hi Sonal, hi Manglam. Yes, absolutely. We do have the mutual fund data and we'll just get to that in just a bit. But yes, the Nifty is hovering around its 20-day moving average, so it's managing to just about maintain those levels. There is an underperformance from the Nifty Bank. It is a lot of the Adani stocks which continue to be in focus on account of news flows. So many of the Adani stocks continue to be under pressure in today's trading session, as you can see. But remember, they've seen a strong run up just in the past couple of days. So the seesaw continues for this entire group. I just want to pull up HDFC Life because that one had seen quite a drubbing post the budget, and now we're seeing HDFC Life gain for the second or the third consecutive day. So up around 2% for HDFC Life, back above 500 rupees. Remember, it had fallen below those levels. And a couple of important cues to watch now that we have the RBI as well as the Fed meet behind us. The next port of call would definitely be on Valentine's Day, not because of Valentine's Day, but because the US CPI data for the month of January will be out, and that's something that the street's going to watch.
All right, Ekta, thanks a lot for reminding all of us that there is something known as Valentine's Day, because I think incrementally, people are moving away from these concepts as
Sure.
perhaps they mature or evolve. Let's see how that comes by.
As long as the markets are open these days.
All right. We were alluding to the mutual fund data. The mutual fund data for the month of January is out. Net equity inflow is about 12,500 crore odd rupees. Large funds have seen inflows after 2 months of outflows. We are now joined by Sunil Subramaniam, who is the Managing Director and CEO at Sundaram Mutual Fund. Sunil, thank you. Always a pleasure speaking with you on days where we do have this data because your insights are invaluable. What we don't have with us right now is the SIP data. But from your conversations that you've had with people and the anecdotal evidence, what kind of SIPs would you expect, taking place in the month of January?
I think it should have around the 100 crore, 200 crore to the overall book size. So around the 13,000 crore mark is what it will be.
Okay. All right. So around 13,000 crore mark, and that's been the case with SIPs as well, right? Because we have seen that number above 13,000 crore rupees at least for the last 2-3 months. Sunil, I wanted your sense on what's happening as far as the equity flows are concerned. There has been a big increase on a month-on-month basis. They've come in at 12,471 crore rupees versus 7,280 crore rupees. What buoyed the sentiment this time just in the equity flows? Because we have been talking about a lot of focus going on debt funds as well. Do you expect this momentum to continue as well?
I think so, because I think that if you look at it, there are 3 components to this. First is that I think a lot of NFOs, the mutual fund industry has been launching. So I think these NFOs have been garnering increasing collections because of the visibility, the advertising campaign around these things. That's number one. Number two is that the data for India has been robust and strong on the economic side. So domestic investors continue to repose faith because they see a good future. So all the uncertainty from mid-December, which has come from the FIIs booking profits and then the Adani-related selling by the FIIs, has not hurt the sentiment of the domestic investors. And I think what was being repeatedly talked about was the fact that Indian markets seem to be overvalued. seemed to be overvalued. So the moment there was selling by FIIs, domestic mutual funds were able to step up their purchasing because retail investors gave them money. So I think the HNI segment of the population, right, I think has looked at the correction as a good point to add more, and they have given money to mutual funds to across various categories of schemes. So I think this is another reason for the buying thing. The third aspect here, I would say, is that if you look at the allocation pattern, right, I don't know the data and the breakup, but generally this is the tax season. So ELSS funds typically see an uptick. I've not been able to see the retail breakup of that, but maybe if that's also a component is added to flows this month, that could be an answer.
Sunil, hi, welcome to the show. Just wanted to touch upon one particular statistic, large cap fund inflow, which is at over 700 odd crores for this particular month versus around 26.4 crores in the previous month, which was an outflow. What would you attribute this to? That there's just a general move towards safety, towards larger cap stocks. Yes, we're still interested in the equity markets, but we're more interested in keeping our money safe with large cap funds as compared to maybe the mid caps, because we still don't know. There are variables such as, the Adani group volatility, which might play out on a larger level.
I think the two things would have driven this, right? I think one is the FIS selling is largely in large caps. So the price corrections have happened in the large cap when FIS sell. So they've sensed a good opportunity to allocate more money to large cap funds so that they can buy those stocks which the FIs are selling. That's number one. Number two is the banking pack. If you see, one of the spin-off of the Adani sell-off was that banks sold off, and banks are a significant part of the large cap index. So I think a lot of HNI money moved into large cap because they saw that valuations have come down because of selling, and it's a good time to accumulate them. I think that's just the kind of, I would say, slightly more smarter thinking from the set of HNI investors in the country.
You know, Sunil, it is said that it is not flows that tail the market, but it's the market that tails the flows. We have seen some underperformance for a while. Underperformance by our own past standards. Of course, as compared to the world, we've done extremely well. What do you think would the trend of these flows be, and the nature? How much goes into debt? What happens to active? What happens to passive? My sense is that the underperformance of the index itself would mean that a lot of money would go into active fund management because of the decline in valuations. Where do you see this trend, going forward?
I don't think investors do so quick readjustments based on this. I think by and large, the sentiment is anchored to economic outlook for the country. I think my sense from that is that as long as the economic outlook for the country is in a good space, mutual fund investors put in money. Now the reallocation between active and passive and all of that, you see, the active, rather than the underperformance of active versus passive in the past, I would say it's more the cost sensitive investors like the provident funds and the HNIs who were tending to go into the passive space. Now I don't see that they'll suddenly change to active because active is able to beat this. And one of the reasons that this has happened is because Adani, though mutual funds didn't hold Adani in a big way, so because of which the benchmark corrected more than the active fund correction. So naturally they are beating that. But I don't see investors changing this because of underperformance or otherwise, right? So I don't see that as a trend. But the second aspect here is that returns, right? Now if you look at the post-COVID phase, right, that's the only time in the recent past that mutual fund investors pulled out money from mutual funds in a big way because they saw the economic downturn of COVID coming. But within a period of, let's say, 7-8 months, right, they started coming back in to the market because the V-shaped recovery came in and because they realized that FIs were buying and the markets were rallying. So I think when they have a good economic view of the country in terms of its growth, right, they tend to commit the capital to the equities markets. And sometimes it happens that when a long period of underperformance and let's say a 3-year SIP has turned negative, that's when they tend to maybe look at it and say, should I reallocate? Your question on equity versus debt, right? And I think that period of people, that the portion of people who switch actively between equity and debt has come down dramatically because they are the hybrid funds now, which tend to get those allocations because the fund managers take the call between debt and equity in a dynamic asset allocation fund.
Okay, all right, Sunil, always a pleasure. Thank you very much for joining in with your views. So that is the mutual fund data for the month of January. Net equity inflow has risen to over 12,500 odd crores versus 7,200 odd crores in the previous month. We need to take a short break, but as we take a break, we'd like to thank our viewers once again. We have beaten all competition on the budget day with a whopping 88.2% viewership during the finance minister's speech. And an 89.8% viewership throughout the day on the 1st of Feb. A big thank you to our viewers for your continuous trust and patronage and keeping it with CNBC TV18. Indeed, a proud moment for all of us here at CNBC TV18.
Welcome back. You're still tuned into Halftime Report on CNBC TV 18. Well, we are seeing some pressure on the markets right now, and a group of stocks which are in focus is the Adani Group. The rout there continues following the notification by the MSCI and the deal with Total Energies being put on hold. Vivek is here to tell us more on this one. Vivek?
Well, that's absolutely right. You know, the group continues to remain in focus. So on January 28th, post the fluctuation that was seen as far as the stock price was concerned, and also the various news flows that was coming in, MSCI had invited response as well as feedback from market participants as well as MSCI members as to how exactly they should use or see the weightage as far as Adani Group stocks in the MSCI Global Standard Index was concerned. Today morning, just prior to the expected release of the MSCI Feb Index review, where they would be announcing the likely inclusions and exclusions, MSCI said that it has received the feedback, and most likely by today you will see some action being taken by the MSCI in terms of the treatment of Adani Group stocks within the MSCI Global Standard Index. Now, why is this important? Now, remember, all of the Adani Group stocks, barring Adani Wilmar as well as NDTV, are actually part of the MSCI Global Standard Index. And in fact, Adani Total, Adani Enterprises as well as Adani Transmission actually have the highest weightage as far as the MSCI is concerned. And these stocks, if they see a weight reduction, could see some outflow coming in on Feb 28. Now, the other important development that you alluded to is the fact that France company Total Energies post its conference call yesterday after announcing the results actually indicated that they had put on hold the expected $4 billion green hydrogen investment that they were going to put into Adani New Industries Limited. So now they've said that they're awaiting the audit results that Adani Group has promised, and post which they will reassess whether or not to enter. And lastly, another development that has come, and it's been reported by newspaper reports, we haven't independently verified these reports. So apparently there was a margin call of more than $500 million that the group had faced before they actually go ahead and decided to pay $1.1 billion share-backed loan, which they did last week. So some important developments, and the stocks continue the volatile ride in today's trading session.
Okay, all right, Vivek, thanks very much for that. So that's on the entire Adani Group. But restaurant brands, which basically runs Burger King and Popeyes, has slipped in trade. It's down around 6% at this point in time, post its Q3 numbers. Manglam, you've been tracking this story. Tell us more.
Yes, Burger King in India and Popeyes in Indonesia. So Burger King in India is not doing particularly badly. If you just take a look at their numbers, 21% growth in their overall revenues. The EBITDA is actually compressed by about 42%. So we've seen margins come down from about 12% to around 5.5%. And as a result of which, the net loss of the company widened from 22 odd crore to 50 crore. Remember, a large part of the loss is also non-cash in nature because of the depreciation. But here's the catch, the India business doing okay-ish as compared to the other parts of their business, 8.6% same-store sales growth. The reason why people perhaps don't like this as much as others is because Westlife Development, the one who runs McDonald's, actually showed a 20% jump in same-store sales growth. They've opened 379 restaurants, or they have 379 restaurants and 45 other restaurants that they've opened in the third quarter. The other margin trigger for them in India is Burger King cafes or BK cafes, which they've opened 72 off in the third quarter and close to around 252 overall. Indonesia, that's the real concern, because revenues in Indonesia absolutely flat year on year. And the business has actually posted an EBIT loss of 18 crore versus a gain in the same time last year. So, that's the one which is pressurizing their operational performance. The growth in India is better than Indonesia, but not as good as McDonald's, which is why we're seeing the stock lower by almost 6%.
Okay, so that's about Restaurants Brands Asia. That stock is in focus. But with that, we'll move on to some management commentary now. Earlier today, we spoke to Sunil Bohra, who's the Group CFO of Uno Minda, on their quarterly performance. And he said that the company is very bullish on four-wheeler lighting business. And in the next 5 years, they'll be able to grow revenues here as well. Listen in.
The board has also approved setting up of a new plant with an investment of roughly 400 crores, for which the location is yet to be finalized. So this is the segment where we are very, very bullish, specifically in the four-wheeler lighting segment. And this space, if you split four-wheeler and two-wheeler, we are already like a fourth or a quarter of market share in two-wheeler lighting segment. But in four-wheeler, we were low, maybe around 13 to 15%. And that's where we see a big potential for growth. In terms of numbers, 650 crore, definitely it can be significantly higher. Our internal target is in next 5 years, we should grow somewhere between 900 to 1,000 crore at least on a quarterly run rate basis.
All right, that's about Uno Minda. Meanwhile, the market's doing well in the mid-cap end of things. A couple of stocks doing well as well. We take a short break, come back. We talk about the indices and individual stocks with Aditya Agarwala of Invest for Edu. Welcome back. You're watching us here on Halftime Report. There is still some weakness for the Nifty, down about 28 points, though it's off the lows of today's trading session. It's off highs as well. And that's really, the tug of war that is playing out today. A couple of things have happened. One, the market has decoupled itself from the weakness that we're seeing in the Adani Group stocks, but it's still not out of the woods. We are facing some technical resistances as well. Yesterday, it closed at the 20-day moving average, but today it's below that for most part of today's trading session. And the 100-day moving average comes right after the 20-day moving average at 17,940. So there is stiff resistance on the way up. And usually it's the Nifty Bank which leads the rally, but over the last couple of trading sessions, the Nifty Bank has underperformed, and that itself has struggled to cross, the 100 as well as the 20-day moving averages. The last hour of trade today will be extremely crucial, and that's because it's got weekly options expiry for it. The fact that we're off the lows has given bulls some support to go ahead and write the 17,800 put. So the 17,800 put saw some writing yesterday as well. And today, as we speak, it's added about 90 lakh shares in open interest for a premium of around 12 rupees, telling you that 17,775 or 17,800, which is closer to today's low, will be an important support zone. 17,850 put 2 has seen a fair amount of writing. However, its inability to cross past that 20-day moving average for the Nifty has given bears some support to go ahead and sell the 17,900 call. So the 17,900 call continues to see some writing, and as we speak, we are seeing further addition to the 17,900 call, telling you that levels upwards of 17,900 could face some resistance, and that's where we are placed as far as the markets are concerned. Support at the day's low of 17,780.
Okay, so 17,780 is the intraday low for the Nifty today. But before we get to Aditya, I just want to point out one particular stock, Piramal Pharma. We've been talking about it all through the trading session today, but now the stock is seeing a cut of around 10% It's at around 89 odd rupees. Piramal Pharma is the one that I'm talking about. Remember that it listed in the month of October, which was the demerged pharmaceutical business of Piramal Enterprises. It listed in October at around 200 rupees. And since then, it's seen a destruction of over 50% in terms of its market capitalization, reacting very poorly to its numbers. Remember, margins crashed around 500 basis points on a sequential basis, and the losses as well widened to around 90 odd crores versus over 35 odd crores in the previous quarter. So extremely weak set of numbers coming in for Piramal Pharma. But let's get a technical check-in. Aditya Agarwal joins in to discuss what he's tracking this afternoon. Aditya, hi, welcome to the show. Well, it's overall a quiet day, but a lot of stock-specific action. So tell us, what's your strategy?
Hi, Ekta. Good afternoon. Good afternoon, Manglam as well. Clearly, it's a bit of a consolidation and a volatility within that consolidation that we're witnessing in the Nifty, Very surprising to see VIX at 13.5, 13 levels, and the kind of volatility we are seeing in the markets. Usually we don't see this kind of volatility at a VIX reading of 13, 13.5. But surprisingly, we are seeing that kind of volatility in the market. And as Mangalam pointed out, 17,900 on the upside is acting as a bit of a hurdle. But if I just go into the internals of the markets, take a look at the intraday charts of Nifty, looks like market is trying to form a base around 17,800, 17,700, and a dash towards 18,000 cannot be ruled out, which we had seen almost on the day of the budget. So once Nifty starts to trade beyond 18,000, that is where when I believe markets will see further leg on the upside. With a good strong support at 17,700, I believe there's a good case for a move at least till 18,000, and then beyond 18,000, 18,200, 300 is what I believe Nifty can test. Bank Nifty is something which is clearly missing the action, and 41,700, 41,800 Ekta is acting as a major hurdle at the moment, and we've seen banking underperform, especially after the Adani fiasco. Most of the banks have underperformed, which is why Bank Nifty is also underperforming. So till the time Bank Nifty crosses 41,700, 41,800, I would avoid trading in the Bank Nifty, but maybe a bit of a short covering in the Nifty cannot be ruled out.
Okay, so that is about the benchmark indices. Aditya, what would your individual technical picks be?
I've got a couple of buy recommendations. One is TVS Motors, which has done well for itself. It's broken out from a narrow consolidation. Volumes are pretty good here. On the upside, targets could be 1,100 with a stop loss at 1,000. One can go ahead and initiate fresh long positions in TVS Motors. The second stock recommendation is Siemens. Stock has been on a tear, continuously making higher highs, higher lows. In a market like this, I would like to stick to a stock which is making new highs. So Siemens is something which is looking very attractive on charts for targets of 30-50. I could go long in the stock with a stop loss at 3,200 on the downside.
All right, Aditya, thank you so much for joining us. So that's a technical check on the markets as well. With that, we'll slip into a break. On the other side, Ramesh Kumar Dua, who is the MD at Relaxo Footwears, will be joining in to discuss their Q3 numbers. Stay tuned for that.
Welcome back. As we speak, a couple of these, non-index stocks have seen a big cut. Ambuja Cements is case in point, down almost 7.5%, and most of the cuts have come by just in the last few minutes or so. It's falling in step with the decline that we're seeing in Adani Group stocks, but now it's seen an accelerated decline on Ambuja Cements, and other stocks also not doing too well. But let's get chatting about Relaxo Footwear. Is it posted a weak set of numbers yet again? In fact, the stock is down about 41% from the highs, and margins this time around have slipped by about 600 basis points as well. We have with us Mr. Ramesh Kumar Dua, who's the MD of the company, joining us now. Mr. Dua, thank you so much for joining in. Time and again, you've said the environment is extremely challenging. You've been sitting on high-cost inventory, which will completely go out in the third quarter. Let's talk about the future now. Is the worst of margins behind you? And at the same time, are you seeing some green shoots in demand? Because all the other FMCG companies are saying that maybe December onwards, things looked much better.
Yeah, I will call it the worst is behind, because the high cost inventory which we are having, most of the inventory we have liquidated. Even with our wholesale channel, their inventory is low, so demand is coming to us, and because of high cost inventory getting diluted, so our bottom line will also improve, and our overall things will also improve. Although market environment remains quite challenging, competitive, and inflationary pressure our mass segment is facing.
Okay. Mr. Dua, in Q2, you had corrected your prices by around 15 to 20%. Is that showing now in terms of incremental demand because your products are cheaper? And do you think that you have to take further cuts?
No further cut required. Our prices are now very competitive, and demand is coming to us, and things are improving.
Okay. So, Mr. Dua, since you are saying that your demand is improving, what kind of volume growth are you anticipating to come by in FY23 and ultimately in FY24? Have you seen a market share shift towards organized players like yourself? And what does it mean in terms of growth that you're expecting in FY24 now that the worst is behind?
You know, the April onwards, that quarter, I think double-digit growth we are expecting. Volume growth in our Hawaii segment, in our EVA flight segment has already started improving. Overall, since the things are challenging and every customer wants to maintain low inventory, that is why our demand is low. But things are happening and they are improving.
Okay, things are happening, they're improving. You said that margins would improve as well now that all the high-cost inventory has been liquidated. Could you give us a sense of how much they would improve by? Because this quarter you did about 10% margins. In the past you've done 15 to 17%, and some point you've done 20% plus as well. So how much is the improvement we can expect?
I think 3 to 4%, maybe around 14% EBITDA we should expect.
This is in the fourth quarter.
In the coming time.
Okay. Can you guide us?
Fourth also, yeah, things will improve.
Sure. Mr. Dua, talking about margins, can you guide us in terms of the input cost pressures as well vis-a-vis the previous quarter?
No, you know, because there was a lot of high cost inventory that affected our margins. Now, since high cost inventory, lot of inventory we have been able to liquidate. So our margins will definitely improve. In this quarter also, they will improve. In the April onward, it will further improve.
Okay, so you're expecting improvement in Q4 and the coming quarters as well. Mr. Dua, when you talk about demand improvement, can you give us a sense of whether it's coming from the premium segment, whether the low-cost inventory is seeing, or the low-cost products are seeing more demand? Is it coming from rural or is it coming from urban areas? What is the split looking like? Where are you more bullish on right now?
At the moment, you know, entire market environment is very challenging. Even in and most affected is our mass segment. There still the consumer is facing inflationary pressure. So there it is more affected than other segment.
Right. You know, Mr. Dua, apart from high valuations and weak performance, one of the other reasons why the stock price also underperformed is one of your key investors, Marcellus, one of the holders, actually liquidated their entire holding of Relaxo Footwears. Just wanted to understand if you had a conversation with Saurabh Mukherjee, what was the rationale behind him selling it, and are you all in talks? I mean, since things will improve, will they re-enter?
No, so that is their outlook. It is how they look at it, the things. Our job is the company should perform, and we are focusing on that. How investors react, how they behave, what is their outlook, that is their personal thing.
But from your end, you believe that the worst is behind, and from here on, double-digit growth and further improvement of 300, 400 basis points in the margins is something that you're extremely confident of, right?
Yeah, exactly.
Okay. Sir, you're doubling capacity in your sportswear segment as well. Can you just tell us what the demand is looking like there, growth rate is looking like there, considering that you are increasing capacity?
You know, capacity has to always increase ahead of curve. So we are increasing the capacity. So next year, because demand of all this sneaker element category is improving, so we are getting ready for that. So the results of those things we will see in the coming year, next year.
Okay, so what is the kind of investment you're making here? You must have assessed the market. You're talking about demand coming in from the sneaker market. What kind of potential market size are you looking at, and your market share there?
Market share I can't comment. I can only comment on what I will be able to do. I think 25% to 30% more sale in this premium segment in shoe we are expecting next year.
All right, Mr. Dua, thank you so much for joining in and giving us your outlook. While the demand is still challenging, you are seeing some sort of green shoots, but you have been confident in saying that the worst is behind the company. Let's see whether investors return, and before that, whether the numbers improve or not. For now, Relaxo Footwear at the low point of trade. We will keep chatting with you through the quarters. With that, it's time to take a short break. But as we do that, we'd like to thank you, our viewers, once again. We've been in all competition on the budget day with a whopping 88.2% viewership during the finance minister's speech. We also got 89.8% viewership throughout the day on the 1st of February. A big thank you to our viewers for your continuous trust and patronage and keeping it with CNBC TV18. It's indeed a proud moment for all of us here at CNBC TV18.
Welcome back. You're still tuned into Halftime Report on CNBC TV18. Markets continue to reel under some pressure. The Nifty is down 50 points as we speak and is seeing some cuts there as well. So let's move on and talk about a Nasdaq-listed software maker, Freshworks, which reported quarter four earnings this week. It was a strong quarter for new business and the company clocked the highest number of new deals in a single quarter. The company also exceeded the annual recurring revenue of $500 million. Reema Tendulkar caught up with Chief Executive Officer Girish Mathrubootham and listen in to what he had to say.
I think we are calling the guidance as we see it. And as we all know, we are living in a tough macro environment. And first of all, I would say at Freshworks, we are happy with how we ended Q4 and how we ended the whole year 2022. Q4 was a strong quarter for us specifically in terms of new business. But a good portion of our growth actually comes from what we call as expansion revenue, which is our existing customers adding more seats and licenses. And because of the macro, we are seeing pressure there, especially when companies are not hiring people or when some of them are laying off employees. So that expansion revenue is under pressure, and all of that is factored into the guidance for 2023. So we are assuming that the macro is going to continue like this for most of the year. And but having said that, if the macro situation improves and companies go back to hiring and adding more people, then we would actually see our growth along with that increase.
So just in the near term, as things stand, perhaps in January and the next 3 months for which you may have visibility, could you give us an indication by how much has your expansion revenue come down? Has there been a drop of 10%? Has there been a drop of 5%? This is the revenue that you get from your existing clients, right?
Right. So I think you can backwork that. What we have actually publicly stated numbers. Net dollar retention is a good metric that used to be in the 115-116% range for us. In the last quarter, it was 107 on a reported basis. So clearly, you could see that expansion is seeing pressure anywhere to the tune of, say, 8 to 10, 11%.
So there has been a decline or an impact of 8 to 10% from the expansion side.
Yes.
Okay, but you're going to use this year to focus a lot on profitability. In fact, that has been the focus. You turned free cash flow positive last year. Now the focus is turning positive at the EBITDA level. Can you walk us through the path to profitability?
Yeah, see, at Freshworks, we have always operated the company very efficiently. In fact, we were free cash flow positive even 2 years ago. I think last year, our cost increased primarily on the basis of the cost of running a public company, right? And there is a lot of G&A spend that we have to incur as a public company, and that we actually told that we will be cash flow positive in Q4, and we came in cash flow positive. We generated 4 million of free cash flow in Q4. And the plan for this year is to be free cash flow positive and continue the journey to profitability. And we are looking at it in 3 steps. First, we will get to free cash flow profitability, and then immediately follow that with profitability on a non-GAAP operating basis. And then the next step would be to get to GAAP operating profit, which includes all the stock-based compensation and all of the other accounts.
All right. With that, let's just keep an eye out on MRF. They reported their numbers. The revenue growth was a little higher than the EBITDA growth, so that indicated some sort of margin compression for them. as a result of which we are seeing the stock currently off highs, lower by almost 1% on MRF. So just watch out for that. Margin miss is something that the street doesn't like. From the highs, we have seen a sharp dip, so we will get some more details on MRF as well. The EBITDA growth lower than the revenue growth, indicating some sort of compression. We take a short break. On the other side, we'll get you excerpts of our conversation with Nick Walker, who's the CEO at Cairn Oil and Gas, from the sidelines of the India Energy Week. Stay tuned.
Welcome back. Well, on the sidelines of India Energy Week, Manisha Gupta, commodities editor, interacted with Nick Walker, who's the CEO, Cairn Oil and Gas, and began by asking him about what he makes of the energy transition and what are the plans of Cairn with respect to the energy transition. Listen in.
Oil and gas is going to be here for the long term, and if you look forward in 2050, so 20, 30 years from now, still 60% of India's energy demands comes from oil and gas. But it's important that we do that in a responsible way. And so here at Cairn, we've set a target to become carbon neutral or carbon zero by 2050. And we've got some really great things going on to achieve that. So it's all about delivering barrels responsibly, low cost, but also with low carbon emissions. And that's what we're about.
I do understand that it's all about innovations, ensuring that the strategies are well planned in a way that there is accessibility, affordability, and also sustainability. How is Cairn looking at all of these various aspects?
No, it's a good question. Of course, we have to deliver energy affordably, and our goal is to deliver it as cheaply as we can. But as I say, it's also about reducing carbon, and we're doing some great things. One of the biggest emitters we have as a business is buying electricity out of the grid, which a lot of it in India comes from coal-fired power. And so one of the things we can do is replace that electricity with renewable energy. So we've recently committed to significant purchase of renewable energy directly from new renewable sources, which is great, and we can do more of that. I want to accelerate some of that. The other thing we're doing is what we can't reduce. We're also looking at natural carbon capture, and we've committed to plant 2 million trees by 2030. And I think all of those things go together to drive us reducing carbon emissions.
All right. What is the kind of conversation that you had at India Energy Week? Because I do understand that there are a lot of investment that are being talked about, collaborations even.
Yeah, no, we've got a lot going on. I think we've got a lot of opportunity to invest into our assets to support the energy needs for India. And I want to move those forward as quickly as possible, and we're focused on doing that. Particularly within our Rajasthan block is the near term. There's a lot of opportunity to continue to grow the resource potential there, but also within our exploration blocks. We've got a big exploration footprint. I'm quite excited by some areas, and if you look at India as a total, there's 30 billion barrels of yet to find in the basins that we've discovered so far, and actually a lot more in the basins that haven't even been explored. So there's a lot of opportunity here to grow the oil and gas production in India to support long-term economic growth here.
Nick, most people believe that the next 5 years are going to be crucial, even critical when you look at energy overall as a space. Cairn as a company, how are you targeting and shaping up next 5 years?
Yeah, no, our vision is to grow the business to be 50% of India's oil production produced in India, and today we're 25%, so we're driving towards that. And as I say, we're investing heavily to grow our resource base and production in Rajasthan, and we've got a lot of projects to do that. But more longer term, it's about exploration, and we've got some exciting things to do there, and we'll be pushing that hard as well.
Also, how are you looking at your spend here? What are going to be your major thrust points going forward?
It's about delivering on that vision, actually, and capital will be able to be provided from the group to do that. But it's really about developing the attractive investment opportunities and then getting after them as quickly as possible, and that's what we're about.
Any numbers that you can share with us on that?
No, I think it's a bit early to say how much we'll invest, but if you look back, we've invested around $3 billion over the last 3 years, and it's a good sort of trend looking forward, that type of level, but it'll go up and down depending on moving the projects forward.
What kind of demand are you expecting coming in from India? Because almost everybody seems to be talking about all incremental demand growth coming in from India.
There's going to be energy growth in India, material, as the country industrializes and becomes more prosperous. And I think India can use all the energy it can generate itself or create itself, and so we're here to play a major part in that.
I'll wind down the conversation with one final question. And there's just so much macro that we're talking about as well, whether it's about China demand coming back or the changing map with Russia, the way it has been delivering to Asia, and US with its sanctions, European Union even. How are you looking at the overall energy map changing with politics, geopolitics in favor?
No, it's changing a lot, and I think the drive for energy transition will have an overlay, and we have to play our part, and we are as a company. But principally, the way I look at this, I can't change the macro environment, but what we can do is we can run our business efficiently as we can, and if we do that, well, then we can create value, and that's what we'll aim to do.
All right, so that's the word coming in from Kane on the oil and gas space. For the equity markets, it's a mixed day. Bank Nifty underperforming. With that, it's also a wrap on Halftime Report. Business Lunch up next. Stay tuned.